Well, hello again. My name is Mark Squires, and I'm the president of Wise Choices Financial, located in the Kansas City area. It is hard to believe that the year is almost over. The third quarter was a bit of a roller coaster with a heap of twists and turns. After hitting yearly lows in mid-June, markets rallied strongly in July and into the first half of August. This was based on what I believe was the market's flawed notion that the Fed would somehow pause rate increases in September and signal an end to future increases. But as we moved into late August, Fed Chair Jerome Powell was very clear that the rate increases would continue until the Fed achieved its 2% target on inflation. Markets sold off following that announcement, but as the quarter ended, markets once more rallied based on comments from Fed Chair Lyle Brainerd that the Fed would eventually reach a point where increasing rates further would pose uneven risk to the underlying economy. Markets took that one sentence to get back on the pause narrative that they had used early in the quarter. Now, although we've seen a decline in the rate of inflation from the torrid pace in June, inflation remains stubbornly high. In fact, the only reason inflation has backed off is because oil has declined to around the mid to high 80s, down from $120 per barrel range. Well, that's good news for consumers, but it's also been about the only bit of good news on the inflation front. Food and staples remain elevated or continue to rise, with some categories in the double figures. Now, some of the decline in the rate of inflation is natural now that summer is over and vacations are done. People can stop traveling, but they cannot stop buying food. Oil is notoriously volatile. It's a commodity that can shift upward on a dime. Plus, the decline in oil is largely driven by a drop in demand due to worldwide weakening economic conditions rather than increased supplies. The price of natural gas continues to rise just as winter is setting in. Putin continues to wage war in Ukraine and appears to be more desperate by the day. Well, he's already turned off natural gas shipments to Europe on several occasions. Now, as I've already said, the quarter was a mixed bag. Gross domestic product in the second quarter was not as bad as in the first, but it was still negative. Third quarter GDP is due to be released on October 27th, and the forecast is that will also be flat. So there's been no growth so far this year. Prices are high, but people are spending, and markets have been holding up mainly because earnings have not been as bad. Now, in my view, it's only a question of time before the consumer snaps and the Fed's rate hikes begin to take a bite. We saw a third rate hike of 75 basis points at the end of September at their Fed meeting, and the Fed still needs to unwind its massive balance sheet. The market seems to go into convulsions as the 10-year Treasury gets close to 3.5%, and that's exactly where we are right now. Companies and consumers will face mounting hurdles as debt service becomes more and more difficult and earnings and pocketbooks get pinched. Paradoxically, higher rates will lead to lower inflation as people have less to spend on products because a bigger chunk of their money will go towards credit card balances and loan servicing. Higher interest rates will likely force companies to curtail spending for the same reasons I mentioned above, and by limiting growth, layoffs may be the next step. Now, the Fed has stated it's fine with the unemployment rate going up as it tightens inflation. Generally speaking, unemployed workers tend to spend less, and this is what it might take to tame inflation, but it will also drive us into a deeper recession. There has also been little help from the current administration in the fight against inflation as more spending was passed via the Inflation Reduction Act, and then there was also the proposal to forgive student loan college debt to the tune of between $500 billion and $1 trillion. Now, as I said the last time we chatted, higher rates would lead to slower growth, and until elevated inflation is tame, we will have a period of stagflation. Now, the talk of a soft landing is not something that I would put a lot of faith in right now, and I think we're headed for some pain, in the words of Chairman Powell. There will be a lot happening in the upcoming quarter, but I think it'll be more along the lines of things settling down. The midterms could hopefully restore gridlock to Washington so that at least the reckless spending stops. Inflation will begin to decline, but at the cost of an economy that will struggle to grow. We still have to face the prospect of a very difficult winter from an energy perspective and an exhausted consumer that may not step up for the holidays. My fear is the Fed overdoes this and continues to tighten all the way to year end. A challenge for the markets is to read the Fed properly and then to work within the new reality. The problem so far this year has been that the markets have missed that. If you've not done so, it's a good time to make an appointment with your advisor. If that's me, give us a call. Any other advisor, give them a call. But make sure that you're still on track to meet your goals with a plan that you are comfortable with. Thanks for watching. Have a great day.